Good afternoon, everyone, and welcome to another session of the November Metals Investor Forum. We're very glad that you're all taking the time to tune in today. I'm sure you're all just looking for something to do while you wait for more ballots to be counted. But if this is the thing you're choosing, we appreciate your time and attention. I have some great companies here today. I'm excited to get some updates on their stories and to ask them questions. To that, please do anytime during my presentation or anybody's presentation, please use the question service on the side there. If anything pops into your head that you would like an answer to, enter your question in the box over there, and I will be sure to pass those questions along to the right person during the Q&A session at the end, or answer them myself if it's me that you're querying. And with that, I'm going to jump into my own talk. Now, I've been giving a version of this talk for the past month. So if you were at MIF a month ago, the essence of the talk is the same. And I don't usually do that, except that I think it's actually quite important right now to remember that things haven't changed that much. There's been all kinds of volatility and things going on in the world, but the premise for the gold silver market hasn't actually changed that much. What has changed is sort of the time frame and the near-term outlook and some of the actions that you can be doing right now. So I've added those in, and I will get right into it. Now, when I say the fundamental premise, I mean what really matters here is that we are in a negative real rate environment. And so this 10-year Treasury indexed chart is a good proxy for real rates. And it sort of shows you how and when the gold market has performed since it got its start in 2016. That my first red arrow, though, points to that the gold bull market started when real rates fell sharply at the beginning of 2016. And then real rates rebounded for a while. That hindered the gold market. And then rates had started to fall again through 2019. That was putting some wind in gold sales. And then we got COVID. And of course, that changed everything. Global or central banks around the world slammed interest rates to zero. With any inflation at all, zero interest rates, of course, mean negative real rates. And negative real rates mean it doesn't pay to hold dollar-based instruments. And so if you want to hold something that falls in the category that those kinds of things fall into, which is usually diversity, low risk, hedging, that sort of thing. Bonds don't work anymore. And so gold really steps into that scenario because it almost always performs when you're in the kind of environment that creates negative real rates. I think one important comment here is time frame. So this is not a short duration event. It took the Federal Reserve 7 years to raise interest rates following the Great Financial Crisis. 7 years. Now, I'm not saying it's going to take 7 years to do it this time. I don't think patterns are that patterns don't repeat in that way. But that time frame matters. Monetary mechanisms take time to have effect. Now, whether you think this monetary mechanism is going to have the effect that it's intended or not is a different conversation. What I'm pointing to is the fact that we are going to be in a negative real rate environment for a substantial period of time. And with any inflation, which is likely for a number of reasons that I'm just about to get to, we will only get more negative real rates going forward. And that is the fundamental premise that supports gold. Now, I just mentioned inflation. Inflation and a weakening US dollar, obviously one in the same conversation. And it is important to reflect on whether this US dollar bull scenario structure that we've been in for quite some time is ending, and I think it is. Now, is that going to be primarily because of inflation based on money printing, inflation based on growth? I don't know. I don't have a crystal ball, but either of those are absolutely possible. Other forces include China consistently in a long game to reduce its reliance on the US dollar. Obviously, Chinese holdings of US dollars is an incredibly important force. And global commodity trade in US dollars is incredibly important as well. And the Chinese are actively working to diversify that mechanism as well. And that all comes to that third point I have there. The reserve currency status for the US dollar is slowly eroding. Now, this is a very long game. I'm not saying that any of this is going to happen tomorrow, but these are all factors that influence the strength of the dollar. And of course, debt loads is part of that. And the trade war hurt the dollar. The trade war has not gone away. It will come back when there's room in people's, when there's space for it to come back. And so I think it's really important to think that, to consider that the US dollar bull market is ending, and that just reduces the headwind that a strong US dollar puts up against gold. Now, when I talked about a negative real rate environment being important for gold, well, the real thing that's going on there, the bigger picture thing that's going on there is huge pools of low risk capital. There's a huge amount of capital out there that is low risk capital. It wants to sit somewhere. It wants to have secure returns. It used to always own bonds and get 5 or 6% annualized returns, and that was great. But that game does not exist anymore. Ever since the great financial crisis, that game is over. 80% of global bonds trade at less than 2% yield. If you account for inflation, they don't pay you anything. It's return-free risk. The bond game for yield doesn't exist. That really changes everything. It means that all of those huge pools of low risk capital have to play stocks now. And that's okay. It's been working. The stock market has done incredibly well since the great financial crisis, but the risks are very real and they're very persistent, whether you're talking about the risks today or a few weeks ago when the stock market was not doing very well, or even a few months from now, maybe the stock market will be doing quite well in that moment, but the risks are very real. If you are managing low risk capital, you have to hedge the risks inherent in owning stocks, and stocks are your only option. How do you hedge that risk? Gold is one of the only answers. And so that is another absolutely essential part of the gold argument. It's not just that gold tends to perform in a negative real rate environment. It is that the negative real rate environment has changed the game for what low risk capital does and has forced it to own gold. The charts here, the table in the chart is about holdings in gold-backed ETFs. And the one on top is year-to-date flows into ETFs, and the bottom certainly shows the gold price in the gold line, and then the colored segments show ETFs holdings for different parts of the world. Clearly, money is flowing into gold-backed ETFs at an incredible rate, actually. And I think there's a bunch of reasons for that. All of the reasons that I've just outlined certainly play a role there. The other thing that I like to point out is that right now there's a bunch of big things going on, and gold works no matter which way any of them go, which is a pretty interesting scenario to be in, actually. But, whether this election ends up with Trump or Biden in control, the Democrats or Republicans in control of the Senate, or whatever it might be, we're still going to be in an environment where there's a major stimulus package in a zero interest rate environment, which may or may not produce inflation because of growth or money printing in itself. But at the end of the day, all of those things are supportive for gold because they're all supportive of negative real rates. And so it doesn't matter, gold wins. Same with COVID. When case counts are rising and people are scared, there's a flight to safety argument in a zero interest rate environment that supports gold. If or when cases start to drop off again, perhaps there's a vaccine, then we would certainly expect there to be growth-based inflation in a zero interest rate environment. Guess what? That works for gold. And same with the trade war. If there's an escalation, gold works on a flight to safety argument, and because the Chinese will step up their efforts to promote a gold-backed or at least non-US dollar trading mechanism, that all supports gold. If there's a de-escalation in the trade war, well, guess what? Then we should get faster growth with inflation in a zero interest rate environment, and that supports gold. So I think it's really interesting that almost no matter how these really important scenarios turn out, gold is the beneficiary either way. The last point that I have there is that whether the stock market goes up or does not, sort of similar to the trade war, gold works in either scenario. Okay, so if gold is so fantastically positioned on a macroeconomic basis, then why has it been struggling of late? Really, it's just about the stimulus package. I mean, there was an agreed upon stimulus package, then Justice Ginsburg died, and the bipartisan divisions put that stimulus package on hold, and then elections and everything mean that there was no possibility of a stimulus package. Now, we still don't know when that stimulus package will be, what size it will be. There's other things taking priority in the moment. The result of that is that growth and inflation expectations are down. They're on hold just for the moment. And that really matters. The thing that fueled gold up so strongly in July and August was rising inflation expectations based on growth expectations because of stimulus. The market needs another stimulus package. The market doesn't actually respond to sort of natural growth anymore. It responds to stimulus-based growth. And so we need another stimulus package, and that's currently in limbo. That is the pause. Gold is having a nice day today, and I think it's a reasonable conclusion that that's happening just because there's a bit more certainty. We still don't know the results of the election, but there's a bit more clarity on what the path forward could be. We're past the worst hurdle, and therefore we're just that one step closer to stimulus, which is the next thing to move markets and increase inflation expectations and set gold going again. There's also been moments in the last few months where there's been a flight to the US dollar in reaction to the lack of stimulus, and based on euro weakness. Euro weakness is certainly because the case counts in Europe of COVID are terrible in a lot of ways. I mean, Britain just re-entered lockdown, and so there's been weakness in the euro for that. The euro represents 56% of the dollar index, so that is a direct bullish force on dollar in the moment. And so that's why gold has taken the dip. Now, when we look at stocks instead of just gold itself, there's a few other factors that are really impacting junior gold silver stocks. One of those is free trade dates, and I've been talking about this a lot in my newsletter. A huge number of junior exploration companies were able to raise capital in May, June, July, and that's fantastic. It meant that they could get out, start exploring. That creates the potential for discovery or resource growth and the kinds of things that make success in the junior space. But all of those financings come free to trade right now, sort of September through December. And if a stock has run during the 4-month hold period, when those shares come free trading, it creates downward pressure on the share price. And we've seen that happen on repeat with stocks in this space. So that's just one of the other forces that's at play. I would say really slow assay labs are also a bit of a hindrance. It's tough for investors. It's hard for anybody to wait 3.5 months for a number to come back from a lab. Investors can start getting concerned about whether there's something nefarious going on. It's just difficult for, companies themselves to ask people to keep waiting, let alone to make subsequent or related geologic decisions, exploration decisions without the numbers. So the really slow assay labs are absolutely a problem. And then there was some profit taking. I mean, that immense gold price run that we had in July and August, you can't begrudge people if they sold into that sum. In fact, so they should have, because this is a high risk trading arena. At the end of the day, this is a bull market. This is a gold silver bull market. And so the question is, what are you going to do about it? And the rationale that I keep returning to when people ask me how to craft their portfolio is, you don't have to be an expert, but you have to decide how much time and risk you want to commit. Overall, you have to decide that we're in a gold bull market, and then you have to watch those forces enough to see when they start to change. That's steps 1 and 2. The third step, if you're bullish, is you have to know yourself. Whether you end up as a trader or a long-term investor, whether you decide to speculate on discoveries and exploration, or position your portfolio to have leveraged exposure to a rising precious metals market, it all works. That's what's great about a precious metals bull market. It just works with different timelines, different risks, and different needs from you, the investor. So play the game that makes sense for you. That's my main message. The GDX is up over 40% year over year. That's not like from the COVID bottom. That's just over the year. It's up 40%. That's a fantastic number. There are lots of stocks out there. I use Evergold as an example, but there's lots of stocks out there in the junior space that have had immense runs, but they are roller coasters. That's the nature of junior exploration. And so don't look at a share price chart like this and say, oh, I could have had a 6-bagger. or whatever it is, a 3-bagger, unless you really believe that you were likely to trade it properly, enter at the bottom, exit at the top, that you wouldn't have gotten attached, that you wouldn't have, ridden it back down, that you would have played it properly. You have to play the game that's appropriate to you, and that really depends on your risk tolerance and the amount of time that you want to spend engaging with your portfolio. If you want to spend a fair bit of time engaging with your portfolio and you're willing to bear a fair amount of risk, then you can speculate on exploration. The first thing that I want to hammer home here, though, is don't let what seems like a flood of discoveries make you think that it's easy. Strong markets meant that lots of companies raised money, as I said just a moment ago. That means that more companies are out exploring. So that means that we're getting more discoveries. But the odds of success on any one target remain very low. Don't think it's easy. The way to hedge that inherent geologic risk is, I think, to demand more than one strong target or project within a company, just more kicks at the can, to demand strong technical competence from the team and strong technical rationale for each target. That one's a bit tough if you don't have a technical background, but it is absolutely essential. And then demand a business plan. This is not a science experiment. I am not putting my money out there so that scientists can go out and have fun. I am putting my money into a junior exploration company because they have a plan for how to create money in the near term. And if plan A doesn't work, they have a pivot to plan B, to plan C. They are in it to make money for shareholders, not because they love rocks. I love rocks too. But the reason to play this game is to make money. So you really need to demand a business plan from any stock that you are invested in. And then there's other risks that need to be managed: permitting, seasonality, access or logistics, marketing. Make sure that they've got a handle on all of these other things, because geology is risk enough. To continue on the, if you like, exploration theme, I would say you really want to make sure that you stay engaged with each stock. We certainly know that a single news release can have outsized impact on a share price when you're talking about a junior explorer, but it's important to not get too attached. I think if you get too attached to the people, to the idea of what might be, to the rocks, then you can just stay in longer than you might need to. Like I said, the odds of success still remain low. And so you do need to cut and run from projects where it's not working. So anyways, make sure you don't get too attached. Try to stay objective about the data and make objective decisions about whether your investment thesis still holds. With junior explorers, you do need to do some trading. You probably need to enter in tranches rather than just jumping all in at one particular price, because the prices usually move around so much. And there are all of these pressures that push junior share prices around. There's speculation before results come out. There's free trade dates that hurt share prices. There's seasonality that pushes things around. If there is a discovery, the price often spikes beyond a reasonable valuation. All of these pressures are very real, and you need to think about them and try and take advantage of them to add to your position or to sell some to reduce your cost base. Manage your risk using the pressures that push junior share prices around. I think that's really important. Participate in financings if it's possible, because warrants certainly give you the opportunity to increase your exposure at a set price if the project works. And then make sure you have a portfolio of explorers. Just like you want a single company to have more than one project or target, you want your portfolio to have more than one company. It's just a more kicks at the can thing. And certainly consider having a range of stages or styles of explorers, discoverers, or business models in there: pre-discovery, discovery expansion, project generators, different geologies like porphyry explorers versus high-grade silver explorers. They operate differently. The market likes different business plans and different geologies at different times. And so try to cover a range and have a bunch of opportunities. I think right in this exact moment, there's two additional, if that all wasn't enough, I think there's two additional things that speculators need to be thinking about right now. One of them is tax loss sales. We've all, I would hope, locked in some nice gains because of the beautiful run that we had in gold silver in the late summer. But recent weakness in the space probably has some positions down too. I entered some positions. I had too much excitement about what was going on in the space, and I bought some things in August that, guess what, didn't do very well. So just last week, I sold them. I locked in gains, quite a few of them. I'm planning on rebuying in December, which is more than 30 days out. So the loss is not considered superficial. I can use the loss as a tax loss, but I can reposition in December to get exposure before what I think will be a strong first quarter. Really, tax loss, if you have gains, look through your portfolio and see if there's opportunities to lock in some losses to offset those gains. I think you can, if you really like the stories, still position in them before the strong first quarter, and it's nice to not pay as much tax. Then there's the opportunity to add to favorite stocks that you like may well be on sale relative to 2 months ago and relative to where I think the market is likely going in the first quarter. So again, pay attention to all of those pressures that I was talking about, free trade dates and news flows and financing needs and all the things that push share prices around so you can try and time your entry. And because it's impossible to do that perfectly, timing the entry around the corporate news flow and around the market, certainly use tranches and consider stink bids to try and add to positions that you really like. As a final comment, if all of that seems a bit much, it's because it's a lot. I mean, I do this as a full-time job, and trying to keep up with the stocks in my portfolio is almost more than I can handle. So if it seems like a lot, then you might want to consider a different approach. I started by saying you have to play the game that is appropriate for you. And it's possible that a lower risk game is more appropriate for you. And what's great is that you can build a buy and hold portfolio that will perform very well through this bull market and won't require much attention and doesn't carry much risk. You can buy large leverage. You can buy large leverage. That was me putting leverage and Barrick together. Large leverage. Warren Buffett bought Barrick because big money buys big companies with strong financials and good dividends. And gold companies are incredibly financially strong right now. I think that's going to increase the generalist attraction to the space. It's a good place to play. You can buy scale and growth, mid-sized operators that have good organic growth built in. You should own some royalty companies. Guess what? Royalty companies have outperformed miners in the bull market, in the bear market, and in the bull market to date. That's a track record that is hard to contest. You can buy optionality plays. Huge assets are specifically hated when the market is weak because they are so expensive to advance. Once the market gets strong and established, guess what? Big mining companies need to buy big assets so that they can stay big in the future. And so the few big assets that survived the hatred get really sought after. Everyone starts chasing those few huge assets. So that's the optionality play. Then you can try and identify takeout targets, which are usually which should be companies that will do well, whether they remain independent through the market or whether they get taken out. And you should certainly make sure you have silver exposure in your portfolio. And there's a variety of ways to do that, but silver outperforms gold in a bull market almost every time. So that's what I have to say. I'm sorry if that was slightly repetitive from a month ago, if you were kind enough to give us your time at that a month ago as well. But I really think that the market is it's in a fantastic place. And what matters is thinking about the levers that are important to you, thinking about the path, the kind of portfolio that works for you, that will let you sleep at night, but give you the kind of exposure and leverage that you seek. And then you need to stick to your plan. Don't get fear of missing out on something that isn't appropriate for you. And then you need to find a few good sources of information to support you through this adventure. I'm a little biased on that front because, of course, providing what I hope is good information is what I do for a living. If you need any more information about my newsletters, I'm easy to find at resourcemaven.ca, and you can sign up for a free trial of what I write there. And that, ladies and gentlemen, is what I have to say about the current market.